stereotypes, breaking the rules. You can't tell me what is for me. Yeah. You got a lot more behind those pretty eyes, but you gotta let the world see. Yeah. So shake it up. Now is the time while you're waiting. You're good enough. Now is the time while you're waiting. What are you waiting on? Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Oh, don't let them bring you down. Don't let them bring you down. Oh.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the NASDAQ Stock Update. Thank you for joining us today. We have two really good stocks to talk about today, Copart and Cisco Systems. I think that you're going to enjoy the information that you have today. What we try to do here is we try to tell you the story about a couple of very special stocks from the NASDAQ 100. Remember, the NASDAQ 100 is the 100 largest stocks that's in the NASDAQ. The NASDAQ's made up of about 3,500 different stocks that are traded on a computerized exchange that's called the NASDAQ. So let's get started today and talk about Copart, which you may or may not know, and Cisco Systems, which a lot of people know about. And that's one of the beauties of what we do today is we help you to understand the story behind stocks so that you can make better decisions on how you invest in stocks. So let's get right to it today. All right, the two stocks that we're looking at today, we're going to throw the spaghetti graph up here right away. We're going to show you what these two stocks did in comparison to the NASDAQ. We're just talking about the NASDAQ 100 since that's probably more representative than anything else that we're talking about. The NASDAQ itself ended off the day a little bit under a point. It's 0.19%. And when you look at the other two stocks that are out there, they did about the same from that standpoint. Copart did a little bit better and Cisco did also. If we look at the numbers, both of them were up for the day. And as we go out and we look at these two stocks over the past 6 months, you can get an idea if you follow the dancing cursor. This was the big market crash that we saw, the coronavirus market crash that occurred in between February and March. And then as we go further on along, we can see how the year progressed and how they have recovered from that standpoint. Now, I just threw up here also the S&P 500 because what we're going to do today is we're going to refer to the S&P 500 in a couple of different ways. And the biggest way that we'll refer to it is as the beta. Remember that when we're talking about the volatility of a stock, how up and down that it may go, we're going to compare that to the S&P 500. And the statistic that you may hear thrown around from time to time is called beta. The beta of the S&P 500 is 1. And you will compare every other stock that we talk about today to that. So if it has less than 1, then that means that it's less volatile than the S&P 500. If it's over 1, then it's going to be more volatile than the S&P 500. And we'll talk about the 500-pound gorilla that's in the room, because if you look at Cisco Systems, you saw a pretty steep drop-off here at the beginning of August, and we'll talk about why that occurred in just a few moments. As we progress on and we talk about Copart, you may or may not have heard of Copart, but if you've heard any of the commercials for you to sell your car at auction or to give it to a charity, it may have gone through Copart. There's really only one or two large online auction companies that take care of salvage cars, and Copart is one of the biggest ones, and it is located in Dallas, Texas. They had a decent day today, up 0.63%. As we look at the valuation of this, you might remember when we talk about valuation, I use Morningstar a lot, but Morningstar doesn't have enough analysts to rate absolutely every stock that exists because, there's 5,000 different stocks in the country. They don't rate every last one of them. They don't rate even every last one of the NASDAQ 100. I wish they did, but they don't. But when they do offer information on stocks that they don't have a real person that rates it, they use an algorithm to rate that. Now, if you look this up on Morningstar's website, you would see a Q that's beside the information. And that's mean it's going to be quantitative information that's supplied to you rather than something that comes from a real analyst in itself. So the quantitative or the algorithm tells us that the fair market value is $79.49. And usually you can tell that it was an algorithm that did it because most of the time the analysts would say, hey, we're going to rate this at 79 or we're going to rate this at 80. They normally don't rate it by, dollars and cents from that standpoint. When you compare it to the close today, it actually closed a little bit under its fair market value, actually over top of its fair market value, by about 20%. So it closed at 103.08, and the fair market value that the algorithm is giving us is 79.49. Now, since we don't have a real person that analyzed this through Morningstar, what I thought I'd do today is just take an example of what other real analysts are saying about Copart. Let's take a look at that. This is kind of like, if you saw a toothpaste commercial and the commercial said for Smiley brand toothpaste, 8 out of 10 dentists say, in this particular situation, we're looking at the number of analysts that are analyzing Copart. And 4 out of 8 of them are saying it's a strong buy, and the other 4 are saying to hold on. The good thing is there's nobody out there that's saying sell from that standpoint. Now, I want you to remember that this is just reporting to you information. So this is education, and this is not a buy-sell recommendation. But it gives you a pretty good idea of how this stock is valued. As we look a little bit further at the moat that's associated with this, remember, when we're talking about the moat, we're talking about the sustainability of profits. So if you have a wide moat, you have a wide sustainability of profits. I think this will explain it to you a little bit better. Watch. You see, when you have a wide moat, you have a wide ability of profits or wide ability to maintain profits is what I mean to say. Now, there's another company out there that's called Insurance Auto Auctions or IAA, and they are really the only main competitor that Copart has. Copart and IAA, they control about 80% of the online auto auctions that are out there. So this company has a wide moat. That we would probably say the same thing about IAA since they control such a substantial part of the market along with Copart. Okay, sorry about that. Another thing that's going on is that the company does take a long-term perspective on growing the company. If you look a little bit further into how the company is owned, you'll even see that there are a number of executives that work for the company that aren't really getting paid anything other than stock options. So they're looking to build the company over the long term and to build it based on the value of the company. And the long-term perspective also adds to the fact that they do have a long moat. They also are expanding internationally. I mentioned that they're based in Dallas, Texas, but they're also expanding further outside the United States. So that's a good thing from that standpoint. When we look at the company over the past year, you can see what happened with the coronavirus market crash. And frankly, they haven't really caught up with where they were in February. If we look at the market value in February, February 19th was their high, which is 104.50. And where it's standing at today is 103.08. So they're real close to regaining where they were, but the market's come back. And in the very beginning, it was rocky, just as it was for a lot of companies which were re-engaging back into the economy. But they've grown back and they basically made it back just about to where they were at their high point in February. When we look at the S&P 500 in there, remember we talked about the idea of the beta. The beta is the volatility comparison. When you look at Copart, Copart's going to be just a little bit more volatile than the S&P 500. The beta on Copart is 1.13, which basically means it's about 13% more volatile than the S&P 500. PE ratio is the price to earnings ratio. And if we compare that to the general market, the general stock market or the S&P 500 average PE is about 29.95. So it's over top of it just a little bit. That might mean to some people that it's a little bit overpriced. It's not high overpriced, but it's a little bit overpriced. So that gives you the idea of why Morningstar is giving it the rating that they do. One thing to look at in all of the stocks that we talk about is going to be the dividends, because really, when we talk about investing money for retirement, there's really only 3 reasons that someone would buy into stocks when they're retired. One's going to be for growth. Now, you might be thinking, geez, I don't have a long time for growth. Look at it in perspective of your individual age. If you are in your 80s and 90s, then probably growth is not going to be something that you're as concerned about. But if you're in your 60s and you're retiring, growth may be something that you're interested in. I've talked about this before, and I use the bucketing system where we go 1 through 10 in the first 10 years of retirement, then 10 through 20, then 20 and 30 and beyond. If you're investing for that 20 to 30 and beyond, then growth is definitely something that you should consider. But remember, this is all within a comfort range. The biggest thing that I tell people is invest within your comfort range. If it makes you lose sleep at night, then you probably shouldn't be invested in it. But if you're thinking long-term and you're okay with some volatility that's associated with it, then growth stocks are definitely something to look at. But the second reason that people invest in stocks is going to be for the dividends. Now, we talked about the dividend for Copart, and there is one, so it's 0. That would not be a stock that you would invest in for dividends. Now, when we get to Cisco Systems in a moment, you're going to be pleasantly surprised by what Cisco Systems pays. So hang on to that, and let's get back into it. Oh, the third reason. The third reason that people invest in stocks is going to be just because they like it. It's just about like anything else. They get intellectual stimulation from looking at the profitability of a company or what the potential is for a company or what you should look out for a company. And I'm here to help you with all that information. So let's get back to where we were and talking about the different companies. Let's get right into Cisco Systems. Cisco Systems, I like the way that Morningstar describes this because in their opinion, Cisco Systems is the only one-stop shop when it comes to networking. You can go to Cisco and you can get your IT specialist, you can get your hardware, you can get your software, you can get everything from Cisco. Cisco has a very wide variety of products available for the networking professionals or for businesses. They were up a little bit today. They also have a narrow moat. you might be wondering, why would they have a narrow moat? Remember when we talked about moats previously, we talked about the fact that Copart has a wide moat. They have a wide moat because they don't have a lot of competition. When it comes to routers and to networking, there's a lot of competition that's out there. So one of the big things that is a good thing that's going for Cisco systems is the switching cost. It costs something to get out of the system that you're in, whether it's going to be the networking in the entire infrastructure that you're utilizing, or whether it's the software or the individuals. There's a switching cost. And sometimes we refer to that as the stickiness of a business. If a business is able to stick its customers to it because of the switching cost, then that's actually a positive in their favor. Cisco also has a very strong brand that's going for it. They have excellent IT professionals. One thing that probably differentiates a wide moat from a narrow moat, and that's the reason why that I believe that Morningstar is assigning a narrow moat to Cisco systems, is the fact that it's the cost. It's not exactly going to be the cheapest product that's out there, but it's going to be preferential in several other aspects. When we look at actually what the valuation is on this stock, Morningstar gives it a 3 stars, which is pretty good. But remember, the star system is it's not like a restaurant. It's not like I go to a 4-star or a 5-star restaurant, because it's going to be excellent. The idea behind the star system for Morningstar is based on value. Value is an intricate part of what the potential is for a stock. So they will say that a 3-star stock is probably pretty close to actually what its value is. And they get the value based on some computations that they use in their investigation. Generally, it's based on earnings per share. The last close today was 42.29. The fair market value is, from Morningstar's perspective, is 48. Now, a lot of times I don't show what other analysts are saying about a stock if we have a Morningstar analyst information on it. But I thought, since I did that for Copart, I would do the same thing for Cisco systems. And when we look at the number of analysts that are out there that are making recommendations on Cisco systems, 10 of them are saying that it's a strong buy. 2 of them are saying it's a moderate buy. 5 of them are holding. None of them are saying sell at this point in time. But I want to remind you that the information that I'm giving you today is educational. This is not a buy-sell recommendation. When we look at Cisco systems over the past year, of course, we see what happened with the coronavirus market crash. And then when we get over here, we see that in August, they've lost quite a bit. And one of the reasons is because of there was lackluster performance and lackluster projections from some of the most recent analysts that are out there. When we look at it in comparison to the S&P 500, what you're going to find is that it's very, very close. The PE ratio was also pretty close to the S&P 500, so there's not much variation. The biggest variation that we're running across right now, this is information that comes from a publication on Cisco, and I want to make it just a little bit bigger for you so you can see what some of the things are that we're saying here. All right. Says basically that Cisco product orders were down, and they're trying to cut costs at this point in time. So they anticipate that there could also be some other reorganization in the future. And that's probably one of the biggest reasons why we saw the market drop right after their earnings call earlier in August. So the future is good. Just right now, there's a little bit of uncertainty that's going on at Cisco systems. Here is the biggest benefit to Cisco systems.
The beauty of your side.
I might have overstated it just a little bit. It might not be the biggest benefit to Cisco Systems, but it's a big benefit to Cisco Systems. They have one of the highest dividends that's paid by a NASDAQ 100 stock. Even though that they have some volatility, I can tell you that if you're a shareholder and you saw the market drop, you're still thinking, I'm making 3.41% in a forward dividend yield, so I'm okay with that. Being paid to hold on is not a bad thing. That's a good thing. Now, remember, though, that when we talk about dividends of stocks, these are all non-guaranteed payments that are out there. But the history of the company is that they do pay dividends. It does vary from time to time. And if you're retired, putting together a portfolio of stocks that pays dividends will help you to create an income during retirement. But you have to understand that the value of those stocks can fluctuate. Their past performance is not a future guarantee, as also goes along with the dividends. The past dividends aren't guarantee of future dividends. That's the case with any dividends that's associated with it. However, they do pay a good dividend currently. So moving on. If we look at the insiders that are going on with these companies, now a lot of times what I do is when I talk about the insiders of a company, what I'm trying to get you to look at is the people that are working at the company. What's their opinion? Sometimes you can ascertain their opinion on the actual value of the stock of the company by looking at what they're doing. If you're an executive and you're selling significant amounts of shares, then perhaps there's a reason for that. And that might be an indicator to the average public out there. It's not private, it's all public information. You just have to research it. On the other hand, if you have executives that are continuing to buy, they have more faith in the company. Okay. Now, you have to take some of that information with a grain of salt because it's not true all the time. Sometimes you'll have more sellers than buyers, and it's just the fact that they're taking some profits off the table, or else they want to use assets for other things. Because you got to remember, the people that run the company, they're human too, and they're trying to prepare their life financially. Just like you have to run your life based on what's going on with you today, they do too. So they may have more financial wherewithal at times, so they're dealing with bigger dollars, but still they're trying to make decisions. But let's take a look at what the insiders are doing, and I think that you can get a little bit better idea. When we look at Cisco Systems, you see a lot of red here. There's a lot of sellers. But one of the things to pay attention to, though, is the number of dollars that are going on. Let me make this just a little bit bigger for you so you can see. Okay, if we look at the number of dollars that are being sold in relationship to the size of the company, they're not big. They're just selling it for one reason or another. Maybe they're buying a house or who knows what. But the idea is it's not like there's millions and millions and millions of dollars that's being transferred. It's a multi-billion-dollar company. So if you see that there's maybe $100,000 sales that are here or there, it's not going to be an indicator of any sorts. So if we were to look at it from the standpoint of the number of buyers and sellers, don't pay attention to the sellers on this particular case because they're small sales. They're not really big. Oh, also, just to let you know, Morningstar does give a standard stewardship rating to this company. That means that they're pretty good from the standpoint of what they're doing for the company. Now, when we look at Copart, Copart is a little different. They have an average buyers and sellers. In the last 3 months, there were 6 buys and 6 sells. In the last 6 months, there were 8 and 13. And then in the last 12 months, there were 13 and 25. Remember when I told you a few moments ago about some of the executives that work for this company, the only way that they're paid is by owning stock. So that can influence the buys and sells at some point in time. So that's pretty even from that standpoint. No big red flags on anything, just good information to research. Okay, we get into this part every day, and I'm just going to take a quick moment and tell you this. We're talking about the ESG. the environmental, social, and governance attributes of these companies. Some of them are good. Most of them are good. Some of them could be considered bad depending on what your preferences are. If you don't like the idea of investing in a company that sells alcohol, then perhaps you would want to know that. If you don't want to invest in a company that distributes pornography, then you would want to know that. Now, we don't have anything terrible to tell you today about any of these companies. But I think that you should be aware of how they're rated from the standpoint of where they are in the spectrum of ESG. So let's add it back in here and look at this. When we let's begin looking at Cisco Systems today. Cisco Systems has excellent ratings from MSCI. I love using MSCI because they have a great staff of people that looks into the intricacies of these companies, and they rate Cisco Systems as a AA company. Now, there might be some disagreement when we come to looking at the BRI in a minute, but from the standpoint of the company itself, they're doing very well. Now, I highlighted Cisco Systems in a presentation that I did earlier this year based on some of the social unrest that had been going on. And I think that Cisco Systems stands as a good role model for a lot of other companies as to how that they run their company and how they're trying to promote diversity. When we look at diversity with Cisco Systems, they have a program that they launched in 2016 that's called their Diverse Representation Network. And this is what it's come out to be. 48% of the employees that are working in the general workforce for Cisco Systems now are minorities. And we look at frontline managers, 38% are minorities that are working in frontline management positions. Now, when you go and you look at other companies, I'll take an example that I used earlier, and that is Nike. Nike is doing a lot to help with social justice and to help with diversity. But when you look at what's going on working inside of the company, it's not as diverse as a company like Cisco Systems. And I'll leave it to you. If you want to learn a little bit more about Nike, go back and look at my video that's on YouTube when we talk about ESG, and I highlight a little bit more information about Nike at that point in time. When we look at Copart, Copart is not as well rated as Cisco Systems by MSCI, but it's good. It's rated as an A. When you look at where they lag and where they lead, they really don't lag in anything when it comes to ESG. They excel when it comes to corruption and instability. That's hopefully understanding that they have good controls in place to make sure that the company is being governed very well and that their monetary systems inside the company are operating very well. Now, if this is something that's interesting to you and you want to look more into these different companies, reach out to me and I'll be glad to give you more specific information to talk to you a little bit more about the environmental, social, or governance aspects. One of the things that I try to do for clients is if you have an interest in ESG and you have an interest in investing in stocks, we have a strategy that we use that's called direct index investing. And what direct index investing does is it'll take, for example, the NASDAQ 100. Now, you've probably seen in the news there's an exchange traded fund from Invesco that's called QQQ. And basically it is a investment. It's investing in the NASDAQ 100. Now, one of the difference, though, between direct investing and buying an ETF like that is that if you don't like some of the companies that are in there, there's nothing you can really do about it. You own it, and that's it. But if you use direct index investing, then basically you're owning the individual stocks, and if there's a company that you don't like what's going on, then you just pull it out. It's really easy to do. That's one of the benefits. Now, obviously, there's a cost in there that's involved with it, and we can talk more about that if that's something of interest to you. So let's get back over to what we're talking about, and we're going to wrap things up for today by talking about the BRI. BRI, remember, is the biblically responsible investing principles of a company, and it deals with customers, community, the workforce, and how a company is relating as a world citizen from a biblical standpoint. Now, when we look at the two companies that we're talking about, Copart actually does pretty good. When we look at the rating system, it goes from a positive 100 down to a negative 100. Now, not to go into the individual aspects of it, but generally speaking, when a company is over zero, from 0 up to 100, they're going to be positive attributes that are in there. And there's a difference in between the two companies that we're talking about today. The company that I am talking about that does the rating is called Inspire. And Inspire's rating from a faith-based standpoint on Copart is plus 30. Now, when we compare that to Cisco Systems rates as a negative 12. It's not anything terrible, but they have some attributes that don't go along with Christian principles to some degree. So they got a negative 12. There are some that are worse, but a lot of this is so individualized. Even in between Christians, there's disagreement into how this is rated. So what I'll tell you is that if this is something that interests you and you want to look more into the biblical responsible investing principles, then reach out to me at van@richardsfinancialplanning.com. And if you have a stock or you have a group of stocks and you'd like to get an idea of how the worldview from a biblical standpoint that those companies are rating, I'll be glad to help you with that. But that comes to the very end of today. Now, what I'll tell you, though, is also as we end that if you want help with your retirement accounts, feel free to reach out to me. I'll add this back in one more time because I have one last thing to show you, and that is that at Richards Financial Planning, we design financial plans that will help you avoid running out of money during retirement. And if you want to find out more about how that we do that, go to my page at richardsfinancialplanning.com. Go down the page and you can't miss the teal colored button. Click on schedule a call to learn more. And then you and I can find a time to talk about your individual situation. And we can talk about the stocks that we've talked about today, or we can talk about what your individual situation is and how that perhaps we can help you so that you don't run out of money during retirement. Now, I'll remind you, just like I do every other day, that if you have questions, send them in. You can write them in the platform if you're watching on YouTube, which I hope you do subscribe to. If you're listening on Facebook or on Twitter, go ahead and enter in information as questions. Tweet it to me or send it to me on Facebook, and I'll be glad to get back to you and answer your individual questions. Or you can email me at van@richardsfinancialplanning.com. Just to end today, remember that there's a disclosure coming up. You can read that if you'd like, and it pertains to everything that we've talked about today. So with all that, I'll tell you thanks a lot, and join us again tomorrow, and we'll cover a couple more stocks. Have a good day.